Welcome to the deep dive. Today we're cutting through the noise around Skyworks Q3 earnings.
Yeah.
For years, the market's often seen them as a bit of a, one-trick pony, really heavily reliant on a single customer.
That's the narrative, definitely.
But this quarter's results, and maybe more importantly, management's strategic signals, well, they seem to be painting a radically different picture.
Mm-hmm.
So, is Skyworks truly on the cusp of reinventing itself as like a diversified RF powerhouse? Or is this just a cyclical bounce? Let's unpack the clues from this report.
That really is the core question, isn't it? This recent earnings call, it truly signals some pretty significant shifts, I think, and strong performance that challenges that old narrative.
Right.
So we'll be meticulously reviewing the numbers, trying to understand the strategic pivots, and ultimately revealing what it all means for Skyworks' trajectory and, for you as an informed observer.
Okay, so let's jump right into those headline numbers from Skyworks' third quarter. They really delivered solid beats across the board.
They did.
Their adjusted earnings per share, the non-GAAP EPS, came in at $1.33. That comfortably beat analyst estimates of $1.24.
Yep, a nice beat there.
Yeah. And revenue hit $965 million, also surpassing the $940.9 million consensus. That's, what, a 6.6% year-over-year growth? Pretty healthy.
Very healthy, but, the financial strength doesn't actually stop there. What's particularly telling, I think, is that their adjusted gross margin expanded to 47.1%.
Okay.
Now, that's up a notable 110 basis points year over year.
Wow, 1.1%.
Exactly. And for anyone maybe less familiar, a basis point is just 1/100th of a percentage point. So yeah, 110 basis points is a 1.1% increase, which in the context of gross margins is, well, it's quite significant.
It suggests a real shift, right? Maybe in product mix or manufacturing efficiency?
Precisely, moving them towards higher value content. And their free cash flow remained incredibly robust at $253 million.
Which translates to, what, 26% of revenue? That's impressive.
It really is, 26%.
That 26% free cash flow margin, that's the financial engine, isn't it?
Absolutely.
It allows them to aggressively return capital to shareholders, which, well, they certainly did. They returned a significant $430 million this quarter alone.
Huge number.
Split between dividends and share buybacks, and they even raised their quarterly dividend by 1% to $0.71.
Exactly. These are unequivocally strong results, especially when you consider the broader industry backdrop. Management's confident tone really reflects this performance.
Yeah, you could hear it.
And the positive outlook they've provided. The immediate market reaction to... we saw the stock jump nearly 8% after hours.
Right, straight away.
That certainly underscores a strong conviction in these results. It suggests the market is starting to believe in this evolving story.
Okay, so the top line numbers are clearly strong. But what's truly driving that growth? What's hinting at this new narrative you mentioned? Let's dig into the revenue mix a bit.
Let's do it.
Mobile revenue, it's still dominated, right? Representing 62% of their total revenue this quarter.
Still the majority.
And their largest customer accounted for a significant 63% of overall revenue. So still very concentrated there.
Yep, that hasn't changed overnight.
But here's an interesting twist. Mobile revenue was actually above seasonal trends. And that strength is continuing into the September quarter. They said it was fueled by healthy sell-through at their top customer and new Android product launches, notably with Google.
Yeah, and what's truly fascinating and maybe less appreciated by the market is the momentum building in their broad markets segment.
Right, the non-mobile stuff.
Exactly. This isn't just some side project. It includes diverse areas like Edge IoT, Automotive, Industrial, Infrastructure, Cloud, all that.
Yeah.
This segment grew 2% sequentially and 5% year over year. Now, that marks its 6th consecutive quarter of growth.
6 quarters. It's consistent.
Think about that consistency. It's now a $1.5 billion run rate business, meaning, if it continues at this pace, it would generate $1.5 billion over a full year.
And crucially,
its gross margins are above the corporate average.
Yeah.
Which points to a healthier, more profitable revenue stream. Management really believes this strong contribution is largely flying under the radar.
And their financial discipline continues to impress, building on that strong free cash flow we talked about.
Definitely.
We already touched on the $253 million for the quarter, but it's worth noting they've returned over $1 billion to shareholders in just the past 2 quarters alone.
That's a serious commitment to shareholder value, isn't it?
It really is. Management also highlighted their disciplined approach to inventory, noting very lean channel inventories. Which, for you listening, that means demand is robust and products are moving quickly, not just piling up somewhere.
Good sign. So, given these strong results and this focus on higher margins, the big question has to be, how are they planning to sustain this? And maybe even expand these margins going forward.
Right. Is it just good market conditions, or are there fundamental shifts happening?
Exactly. And management outlined a very clear strategic initiative to achieve this. The planned closure of their Woburn wafer fab.
The fab consolidation.
And the consolidation of operations into their Newbury Park site.
So shutting down a major fab like Woburn, that's not just like moving the office furniture, right? That sounds like a massive undertaking.
Oh, absolutely. It's a huge deal.
What does that signal about their commitment to this long-term efficiency plan?
Well, it's like taking a finely tuned machine apart to rebuild it even better, The strategic rationale is crystal clear. This move is designed to drive higher fab utilization, lower those fixed costs, and to just improve overall efficiency.
Makes sense.
By shifting towards more advanced, higher value content, this consolidation is intended to position them for significant gross margin expansion over time. It's a bold move, definitely.
Yeah.
And it shows they're really putting their money where their strategic mouth is, so to speak. But remember, the full financial impact of this won't be immediate.
Right, not next quarter.
It will materialize over a longer term, not in the immediate next quarter or two.
Okay. You mentioned the mobile strengths earlier, but what about all the buzz around AI-capable phones? Is Skyworks really positioned to ride that next wave, or is that still more, hype than substance for their business right now?
That's a great question. And yeah, management addressed it head on. They see significant long-term RF content growth drivers here, especially from opportunities like internal modem adoption by their top customer.
Okay, explain that a bit. Why is internal modem adoption so important?
Well, it's crucial because when a major phone maker designs its own core communication chip, the modem, it often opens up previously closed off design spaces or sockets inside the phone.
Ah, okay.
Spaces for specialized radio frequency components that Skyworks excels at. It's kind of like getting a key to rooms they couldn't enter before.
Gotcha.
Which is why management sees it as a natural tailwind. They also highlighted the increasing RF complexity that just comes with integrating advanced AI features into phones.
More complexity means more opportunity for them.
Exactly. They believe this could drive an inflection in upgrade cycles, potentially shortening the current, historically long smartphone replacement cycle. Which is, over 4 years now?
Feels like it.
Right. They did acknowledge, though, that this year might represent a low point in content at their largest customer. But the focus is squarely on changing that trajectory with these new opportunities.
Okay. And beyond mobile, their broad markets diversification, you said it's really coming into its own. What's exciting the most in those areas?
They're clearly very bullish on it. In Edge IoT, for example, they're seeing accelerating Wi-Fi 7 adoption.
Wi-Fi 7, okay.
Across consumer, enterprise, industrial applications, you name it. This next generation of Wi-Fi demands faster speeds, ultra-low latency, which translates directly to greater RF complexity.
Meaning more sophisticated components needed from Skyworks.
Precisely. And get this, they're already investing in Wi-Fi 8 R&D.
Wow, already.
Yeah, showing they're thinking years ahead. Automotive is another key growth driver. It's characterized by, those long design cycles, but incredibly durable revenue streams once you're in.
Sticky business.
Very sticky. They specifically mention significant design wins with major players like BYD, Ford, Geely, Nissan.
Big names.
Yeah. This automotive business is now tracking around $60 million per quarter, significantly up year over year.
What kind of stuff is that covering in cars?
It's covering everything from 5G telematics, over-the-air updates, advanced infotainment systems, a lot of growth areas.
And what about data centers and infrastructure? That was a weaker spot for a while, wasn't it?
It was, but business activity there is clearly rebounding now as inventory normalizes. Accelerating AI workloads are driving upgrades to 800 gig and even 1.6 terabit switches.
Which means?
Which means significantly increasing demand for Skyworks' precision timing solutions. That inventory overhang that was a concern in previous quarters for this segment, management says it's now firmly behind them.
So a much healthier demand environment there, too. It sounds like they're kind of hitting on all cylinders for growth in these diverse segments now.
That's certainly the picture management painted. And their outlook, it reinforces that bullish tone. For the upcoming Q4 FY25, they're guiding revenue between $1 billion to $1.03 billion.
Okay, hitting that billion-dollar mark again.
And non-GAAP EPS of approximately $1.40, Gross margin projected around 47%, plus or minus 50 basis points. And OPEX between $235 million and $245 million.
And how does that guidance compare to what the street was expecting?
That's the key part for you listening. This guidance is notably above street expectations, which, speaks volumes about their confidence in the momentum we've just been discussing.
Interesting. And on the leadership front, any changes there?
Yeah, they introduced Rob Schreisheim as interim CFO. He's actually a board veteran, been there nearly 20 years, so that ensures continuity during this transition.
Okay, so experienced hand stepping in.
Exactly. They also mentioned the search for a permanent CFO is near completion. The CEO also really emphasized their strategic philosophy again. The importance of diversification beyond their single customer concentration isn't just about market perception, it's about improving valuation multiples.
Right, trying to get the stock valued higher.
Precisely. They are prioritizing gross margin accretive, stickier businesses, as you said, with longer revenue time constants. And they're openly considering accretive mergers and acquisitions to maybe further accelerate the strategy.
M&A's on the table then?
Seems like it. And despite these targeted R&D investments in new growth areas, the company plans to be very disciplined with OPEX going forward. They're expecting nominal growth rates there.
So controlled spending.
Yeah, this focus on operational efficiency alongside strategic growth outside of their core mobile business is just a consistent, powerful theme woven throughout the entire call, really.
It's important, I think, to frame these results in context. This earnings call, it comes after a period where Skyworks stock significantly underperformed.
Oh yeah, big time. Down 38% over the last year compared to the SOXX semiconductor ETF's 17% gain. Ouch.
And there was even an approximate 8% slide just heading into these earnings amid broader sector rotation. So yeah, the stage was definitely set for some volatility.
And we certainly saw it play out post-earnings.
We absolutely did. The immediate, strong, positive market reaction to this quarter's results, that nearly 8% jump after hours on heavy volume. It stands in really stark contrast to the more measured hold or neutral ratings from many sell-side analysts.
Interesting divergence there. What does that tell you?
Well, it suggests strong investor conviction in the company's trajectory, maybe seeing a potential inflection point that the analysts haven't fully bought into yet. The narrative, as you alluded to earlier, it seems to be genuinely shifting.
From cyclical handset hostage
to potentially a balanced RF platform.
That's a powerful shift in perception, and the market reaction certainly supports it. But for you, the listener, what's the biggest remaining risk to that balanced RF platform narrative? Isn't that customer concentration still a huge overhang for some? You hit it right on the head. That's the main thing. While they are actively diversifying into these higher growth, higher margin verticals like automotive, IoT, infrastructure, and these collectively represent a substantial and growing part of their business now.
Yeah.
The significant customer concentration, it absolutely remains the primary risk flagged by some of the big long-only funds. However, if they execute on the manufacturing efficiency, the fab consolidation, and continue this diversification strategy,
And maybe.
then maybe 2025 could truly mark that transition from just margin repair to sustained expansion. This would firmly position Skyworks as like a recovery play within the semiconductor space, rather than just a derivative on their largest customer's next iPhone cycle or whatever it might be.
So what are the key catalysts for people to watch then?
Okay, key things to watch. The ramp of flagship AI phones, definitely. Those Wi-Fi 7 customer launches, probably see some at CES early next year. The progress and eventual closure of that Woburn fab slated for early 2026. And, any developments related to global tariffs could always play a role.
Got it. Okay, I think it's time for our This Is Not Financial Advice segment.
Let's do it.
Where we lean into those audacious but, maybe plausible trade ideas for the astute investor listening.
All right. Given everything we've just unpacked from Skyworks' earnings call, here's a thought. Consider perhaps a long position on Skyworks, ticker SWKS,
Okay.
with a corresponding short position on a pure-play smartphone component supplier, one that maybe lacks Skyworks' diversified, high-growth, broad market exposure.
Interesting pairs trade idea. What's the thesis?
The thesis is basically that Skyworks' strategic pivot, that internal modem content tailwind we talked about, combined with the potential AI phone refresh cycle, all that will drive significant margin expansion and potentially a re-rating of their stock multiple.
Allowing them to outperform the more handset-focused peers.
Exactly. Outperforming peers who are still heavily reliant on just undifferentiated handset volume. The market's initial strong reaction signals, I think, a willingness to reevaluate the stock, even if the sell-side analysts are still kind of catching up.
Okay, an interesting play. Betting on the diversification and the content story over just pure volume. What's another angle?
Well, alternatively, if you're really bullish on the long-term margin story, maybe you believe the market still hasn't fully digested the benefits from that fab consolidation in the accelerating broad markets business.
Yeah.
You could consider a more leveraged bet, something like a long out-of-the-money call option on SWKS, maybe expiring out in Q1 2026.
Okay, explain out-of-the-money call option for folks maybe less familiar.
Sure. It basically gives you the right, but not the obligation, to buy shares at a price that's higher than the current market price.
Right.
So it's a higher risk, potentially higher reward play. You need the stock to move up significantly just to break even.
Right, so why that specific strategy and timing?
Well, this specific strategy would give you exposure to those positive catalysts we mentioned, like the Wi-Fi 7 CES launches and maybe clearer timelines on the Woburn fab closure emerging by then. It could potentially leverage that implied volatility increase we saw post-earnings for significant upside.
But definitely higher risk.
Oh, absolutely. It's for investors willing to take on more risk for higher potential reward, really banking on a significant positive price move once those benefits become clearer to the broader market.
Okay, so two different ways to potentially play this evolving story. So let's recap our deep dive then. Skyworks delivered a remarkably strong quarter.
Yep, beats on top and bottom lines.
Impressive free cash flow generation and a significant boost in their guidance for next quarter.
Can't argue with the numbers.
They seem to be clearly executing on a very precise strategy. Diversify the revenue streams, optimize the manufacturing footprint, all aimed at long-term margin expansion and sustainable growth.
Yeah, the shift towards AI-capable phones that accelerated Wi-Fi 7 adoption, robust growth in automotive and data centers, it seems to be positioning them well beyond just being tied to handset cycles.
But that customer concentration.
It remains a factor to watch, absolutely. But the strategic direction and the execution outlined on this call, I think they provide a compelling case for a fundamental reevaluation of the company's prospects.
Right. Remember, this deep dive is crafted specifically for you listening. We encourage you to dig into these insights further, maybe read the transcript yourself, and let us know what stands out most. Could this truly be the inflection point where Skyworks sheds its old skin and emerges as a fundamentally different, more diversified company? Something to think about. Thank you for tuning in to The Deep Dive.
We look forward to our next discussion.